Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode 74, we're going to look at how you value retained interests under Code Section 2036. In a previous episode more recently, I covered some of the basics of Code Section 2036. We talked about how in the worst case, what it does is it causes all of the assets of a trust that was created by a decedent to be included in that decedent's gross estate due to the retained possession, control, or enjoyment under the trust. And that's our default rule is that the entire fair market value of the trust would be included in the gross estate. But there are some exceptions to that rule depending on what type of interest the decedent retains. So we're going to look at those today. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, there's a reason I'm bringing this up, especially with the election close at hand, because there may be some gift tax strategies inherent in these valuation rules that you or your clients are not necessarily thinking of. So, the general myth among a lot of practitioners is that you should avoid at all costs inclusion under Code Section 2036 because typically it applies to the entire principal or corpus of a trust or of a life estate. In a situation where the decedent has created that trust and then dies holding control, possession, or enjoyment, or releases control, possession, or enjoyment within 3 years of death. But there's a couple of exceptions that we're going to look at when you have trusts that maybe distribute all of their income, or when you have trusts that are set up as an annuity trust or unitrust, or where the decedent did not control the entire trust. Now, to start with, in a situation where the decedent didn't control the entire trust, you really just look to the portion of the trust they can control. And then also, in a situation where maybe there's a bona fide sale, Code Section 2043 might prevent part of the corpus of that trust from being included in the gross estate. But that's a discussion for another time. But the big picture for today, and this is kind of punting this to episode 76, where I'm going to cover the strategies inherent in these rules, is that if the Code Section 7520 rate goes up, which is almost inevitable given how low it is right now, what that means is that inclusion under Code Section 2036 may not be a bad thing as long as the trust is not an abusive trust for purposes of the Code Section 2001 G2 credit. And we talked about that in a previous discussion where if the exclusion amount goes down from 11.58 million to maybe 3.5 million or 5 million, and if you use that exemption right now, you're not going to get dinged for it because you'll get an offsetting increase to your applicable credit against estate tax through Code Section 2001 G2. Now, some recently published regulations posit that if you create a trust and retain an interest, it may be abusive and you may be denied that credit. But if you use techniques condoned by the IRS that we're going to look at, you may still be able to get that credit and avoid that abusive type of argument while getting a valuation benefit with respect to your retained interest. Now, starting off with bare income interest, where maybe you create a trust but retain the right to receive mandatory distributions of income, usually the entire corpus of the trust would be included in your gross estate. But if that mandatory income interest is spread across multiple beneficiaries, one of whom is you, then you can start by only including that portion of the corpus attributable to your percent of annual income. So if you and another beneficiary each receive 50% of the income annually, then you'd only have to start off including 50% of the trust. Now, if the other income beneficiary or beneficiaries outlive you, then you'd also have to include some actuarial calculations where they're equal to the excess of the value of their 50% interest over the present value of their retained income interest. So it wouldn't necessarily be that you only have to include 50%. You'd have some other things that come into play in that calculation. And we're not going to go into the specifics of the IRS factors for calculating a life estate today, but that's the first hint that there could be some relief that you don't have to include the entire trust in your gross estate. Now, what's truly neat in these is the rule that applies to annuity interest. Now, we're going to assume we have an annuity interest that's not graduated. In other words, it doesn't increase year over year by an amount up to 120%. Now, where annuity interests are involved, you could include less than the corpus of the trust. It's really the rule is that you include the lesser of the corpus needed to generate that annuity or the fair market value of the corpus of the trust. Now, if you can come out under that fair market value and just look at the corpus needed to generate the annuity, you could have a valuation discount there. So in order to do that, it's a simple calculation. You simply divide the dollar amount of the annuity by the Section 7520 rate applicable at the decedent's death, regardless of the term of the trust. So if you create a trust that has an annuity return right now, and then the 7520 rate goes up, what that means is that that increase in the rate is going to reduce potentially the amount included in your gross estate. Now, if you die when the 7520 rate is low, that might not be a benefit, but the increase in that rate might be a benefit, with the trade-off being that you get less of a step up in basis for those trust assets because there's less included in your gross estate. Now, with the unitrust interests that are not graduated, the calculation gets a little bit more difficult. So you basically have to determine the ratio of the adjusted payout rate to the 7520 rate. So if that ratio is equal to or greater than 100%, all of the trust corpus is included in the gross estate, but if it's less than 100%, that's the amount or the percent that's going to be included. So you have to first multiply the trust payout rate, whatever that might be, by 1 minus the adjusted payout rate that's determined under the code section 664 regs. Then you divide that amount by the 7520 rate that's in effect at death to determine whether you're over or under 100%. Now, with graduated annuity payments, it gets a little bit more difficult. Now, with the first year annuity payment, you'd take the amount of principal that generates that payment simply by dividing it by the 7520 rate. But you have to look at the remaining payments over the term of the trust. And this is an important distinction going back to the annuity interest, is that this calculation with the annuity or the unitrust is not dependent on how much of the term of the trust remains. The rule is still the same, even if you have 100 years left on the term of the trust. But with a graduated annuity payment, usually you'd see this with a shorter term type of grat, usually, where the annuity payment might increase by up to a maximum amount of 120% each year. Now, year of death, you'd calculate it the same, but in other years, you'd have to determine the amount of corpus necessary to generate that annuity by taking the periodic addition, the dollar amount of the increase in the value of the annuity, and you'd have to multiply that times an adjustment factor and then by the 7520 rate, and then your subsequent year additions would also have to be multiplied by the deferral period of the annuity and a present value factor. Now, that's a mouthful, and I can't really give an example other than the best one, which is the example from the code section 2036 regs. This illustrates how the graduated annuity would be paid out. And just to preface, this was a 5-year grat whose fair market value at date of death was $3.2 million. Now, what we can see is that if the decedent died in year 3, we'd calculate it the normal way. We'd have 144,000 divided by the code section 7520 rate in effect at death, which was 6.8% here. And that would give us 2.1 million and change. But then we'd take these periodic additions in later years and multiply them out by columns D, E, and F, as we see, to arrive at the additional principal you must include necessary to generate those graduated larger annuity payments over the remaining term of the trust. So it's a more difficult calculation, but it still shows that you come out under the $3.2 million fair market value that was in the regs. So here's my overall takeaway, and this is punting to episode 76 in a bit, where I'm going to walk through these in greater detail. But right now, a grat or a cupert may be a good idea because the 7520 rate is low and is sure to go up. And even with that, a long-term grat or cupert may even be a good idea because, one, The retained annuity or use right is not dependent on the term of the trust, and two, it's because with the exclusion amount potentially going down, you still get a credit for using it right now, and even if you retain an interest through a GRAT or QPERT, you have a stronger argument that that might not be an abusive trust, so you don't care as much about what amount of that trust might be included in your gross estate post-election, even if the exclusion goes down, because your exclusion for purposes of that trust and the applicable credit amount is going to be frozen in time at when the trust is funded. So overall, the 75/20 rate increase is a safe bet, even though we have no idea what's going to happen with the estate tax applicable exclusion amount. So as I said, more is to come in episode 76. But for the time being, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.